Hey guys, Don Durrett, Goldstock Data. I decided to do a video for you today. Um, First thing that I want to cover is how to follow me. But before we go into that, I want to kind of give you an overview of what this video is about. Um, I wanted to do this how to follow me, but I decided to add some additional information. So I'm going to do a little bit of macro, not very much, 10 minutes. And then I'm going to show you how to analyze stocks. Um, and give you some insight on that. So kind of give back to a little bit to you guys today. Um, okay, so the first thing, how to follow me. There's really, I have three methods here. The first one is the economic method, which is the cheapest method. And that one I would recommend just being a regular subscriber to Goldstock Data, that the low entry price, 199, and then follow me for free on Twitter, Don Durrett, and then follow me. Well, join my Twitter community, Gold and Silver Mining Stocks, but you have to request that. So send me a DM or an email and join it. Because sometimes I post in the community. Community is up to 1,000 people, and sometimes I post there and I don't post it on Twitter. And then you want to join Substack and follow me for free, because sometimes I post there. If you join Substack for free, you'll get an email. So if I post something in the forum, you won't get an email, but sometimes I'll post it for free on Substack. And the reason why I'm using Substack is it's free for me to use. It's like free marketing. So I started posting on Substack. It's an easy way for me to post information to expand my reach, if you will. And like I said, they let me use it for free. And the way that Substack is designed is to pay the people that provide content, but you don't necessarily need to pay. It's either $8 a month or $80 a year, because most of the stuff that I post on Substack, I also post in the forum. The benefit, if you join, is that you'll get an email. So sometimes I don't post a lot on Substack, maybe once a week. I do post my Friday recap. So you'll get the Friday recap emailed to you if you follow me on Substack. And then Seeking Alpha, I usually post one article a month there for free. They're not all free, but if you join for free, some of them are behind the paywall, some of them are not. But it doesn't cost you anything to join Substack. I mean, Seeking Alpha, if you join it for free and then follow me, if I post something, you'll get an email. So this is the way to follow me, the economic way. Recommended way is all of the above, except I recommend the premium subscription. And the reason why I recommend the premium subscription is this drop-down list. So if we go to search and compare, this drop-down list is premium. You don't get this if you're a regular subscriber. And these searches I think are worth $100. You get all the searches that are in the newsletter, but now you can you get the additional data. The newsletter only gives you like 5 columns, but here, like if I do the silver miners, you get the data, plus you can scroll over, you get more data. So that drop down list alone is worth the premium, but you get additional stuff. I'm not going to go into the additional premium you get, but that alone is worth the $100. And so the other one that I think is really good is the ability to export data. So I do use that a lot. So you can basically create your searches in GSD, and then you can export them to Excel. So that's another, but we also have emails on the premium, and the email support is actually the reason why we charge extra. So you get daily emails if you're a premium subscription. I wanted to change it so that everybody got the emails, but it's too much, the support's too much. So that's the reason why we split it from $199 to $299. It's mainly because of the email support. It's not easy to do those emails. It's a bit of a pain. And then this is what if you're gonna, basically, if you can afford it, if you will, this is what I call the full way to follow me, is to this premium subscription, free Twitter, and then free, both of these Twitters are free. And then Substack, if you pay $8 a month or $8 yearly, you're going to get, anything that I post in there, you will get. There are a few things that I post on Substack that you might miss because if you don't go into the forum. So if you pay that, you're going to get anything that I post there. And since people started paying me, because again, the way Substack works is they pay for content. So people started paying me. So since they're paying me, I provide them with a few, nuggets every month, so there's that. And then on Seeking Alpha, I have an investing group. And the reason it's $30 a month or $300 a year, these are the minimum prices that they charge. So that's the minimum I can charge. The reason why I created this investing group is because Seeking Alpha doesn't like the way that I analyze stocks. It's very unorthodox because I base my valuations on future prices, and that's not how the normal world works. And they get very frustrated at that. They bounce back a lot of my posts. They reject them. So it's been a pain, and to use Seeking Alpha. Then the other thing is they consider anything that's under 150 million to be basically a micro cap, and they won't let me post anything on the free. So I've Seeking Alpha free. Anything that has a share price under 50 cents, they will reject. They won't accept it. So I can't do any micro caps in my free. And even ones that are over 50 cents, they will reject them sometimes. So I was going to quit Seeking Alpha, and then they told me, well, if you create your own investing group, you can post whatever you want. So they don't edit it, they don't approve it. I can post anything I want in this gold and silver mining ideas. And so so I started it up for that reason, so I could post whatever. And then I actually create portfolios in there. So there's like 7 portfolios that you don't get in GSD, these extra portfolios that I've created. They're like ideal portfolios. So I'm there. If they were going to let me create this investing group, I decided, why not do it? I mean, they actually sent me the email and told me, because I was told them I was going to quit. So okay, I'll create one. So I created this investing group. It's very small. I think there's like 20 members in there, but it's there for anybody again, that's the full way. Okay, so now we're going to go to macro. Now a lot of times these YouTube videos last, I usually don't pull them down for a year or two. So it's kind of, for me to do a macro, because a lot of people are probably going to be watching this, 2 months from now, 3 months from now, 6 months from now. I don't know how long I'll keep it up. But what I'm about to say, it could be, way off base. Because a lot of times macro is always, when I do macro, I kind of focus on the future, right? Okay, so the first thing is gold. The high was 2450 in New York, right around 2450. And then I don't know if we got to 2500 in Shanghai or not. If we didn't, we got really close. I think it might have got over 2500 in Shanghai. And then silver only got to 3250 in New York, and it got to almost a 37. I want to say it got to 3680, something like that. It got really close to $37 in Shanghai, which was kind of amazing. And it stayed over $34 for like 2 weeks in a row. I mean, it was really strong. And then last night was the first night that I saw it under 34 in 2 weeks. I wasn't surprised that silver was weak. It was down today, low 29s. I think that this run is kind of over, if you will, for gold and silver in the near term. The S&P, it's still running. Today it had an all-time high around 5350. I think it was a little higher than that. I'd use 350 because it's kind of a round number. I think it might have got as high as 5370, 5375, somewhere in there. I thought 5200 was going to be the high in the S&P this year. I'm kind of shocked that it's been this strong, and we're here in almost the middle of June, and the stock market is really, it had one since October, it's had one little 5% correction, and Wall Street remains unbelievably bullish. So I think this is the very last run, and I think that once it rolls over, then I think gold and silver will start to go back up. Initially, I think they'll go down, they'll go back up. But my point is that I don't care how much the S&P continues going higher here. I do not think that gold and silver are going to basically make new highs. Now, 3250, let me preface that a little bit. I mean, it wouldn't shock me if silver made a run at 35 or silver made a run at 2,500, but that's about as high as I think they can go, if you will, as far as a melt-up scenario goes. As far as a melt-up scenario goes, I don't think that the S&P can go much higher, if you will. David Hunter thinks it's going to go to 6,000 in July or higher. I don't see that scenario, and I don't think that gold and silver is going to, basically break out and bust out here. I think all three of them are kind of making cycle highs here, and that this is kind of the last. Again, remember I said that you do macro and you're going to regret it. You leave it on, you leave it here for 6 months, and you're going to regret it. I think all three of these are making cycle highs here. And I mentioned these are the kind of these levels right here, I think are really close to these cycle highs. And then what's coming is basically a cycle low. And the cycle low, I think, will occur somewhere between now and August. And maybe it rolls into August, maybe it rolls all the way into September. But that cycle low, I think, is coming. It's on its way. And so the reason why silver paused here at 3250 is because the cycle low is coming. It's like it couldn't break out because it's like, whoa, hit the brakes. Little sis, she took off her running shoes. She basically hit the brakes at 3250 and said, whoa, we can't go much fire here. We still got to backtrack a little bit. And so she backtracked to 29, and I think she's going to backtrack even further. My target is 26 to 28. I'm hoping 28 holds. And then on gold, I'm thinking it's going to go to 2150 is that's kind of where I think it's going. 28 on silver and about 2150 on gold. So we're going to get these backtracks, these cycle lows are going to get put in. And when those get put in, I think the S&P is going to be trading under 5,000. So it's currently about, 300, we got quite a ways to go. 10% will take you below 5,000. And I think that when everything starts to really flip here is when you get below 4,800. I think 5,000 is when Wall Street gets nervous. 4,800 is when they start selling. Those are the two kind of lines in the sand. I'll also say that I don't think that silver really is important here. I kind of think it's irrelevant because I think the big dog is going to be gold, and gold is really going to tell the tale on how low silver goes and then when silver bounces. And so since I don't think that gold's going to break down, I don't think we're going to retest 2000. I mean, it's possible you could retest, say 2050, 2070, but that's kind of as low as I think it'll go. And I don't even think we're going to go that low. So as long as gold doesn't break down here, once it bounces, silver will bounce. The GSR will squeeze really rapidly. I think the GSR squeezed just recently. I think it got down to about 70. I'm not sure the exact number. If we use the Shanghai numbers of $37 silver, it got below 70. So it can squeeze, it'll squeeze really fast. And yeah, so I've been saying this, I'm waiting for this risk on trade on Wall Street where, all they want to do is buy stocks. They don't care about any risk off investments. I mean, a big sign is Newmont. So if we look at Newmont's chart, it's really the telltale sign. I mean, you have gold, and then you have, let's see, the 5-year. You have gold, and then you have Newmont as the kind of the two indicators to follow. So Newmont, I think, is really the big dog. But I mean, if you look at $70, so right now it's trading at 40.65. Which is, I mean, it's really pathetic. I mean, it really needs to get back to 70. So, I mean, that's almost 100% move would be 80, but that's where it's going, 70. That's how far it's got to go just to rotate back to where it was. So this was August. So we go and we look at, that's November. So if we go right here, so there's August, almost $70. $69 in August. And that's where it needs to basically go back to. So we're still in retrace mode. So you can see that Newmont it's not even, it's not even breathing basically. I mean, it broke down. It was all the way up here at $80. It broke all the way down to 29, showing 31. That was a close, but it actually it was trading sub 30. And the volume was pathetic. And the volume has been very pathetic. So here we're at $40. And I think I think Newmont's going to, north of 120. Let's just put it that way. 150 is kind of where I think it's going to go, and possibly higher. So this thing's going to double. It's going to go from 40 to 80 once the sentiment flips. So you can see the miners. I mean, the Hui right now is just pathetic. So we look at the Hui. This is what I've been following forever. So if we look at the Hui for 5 years, so back here in 2020 it was at 350. I think it got to 360. There's 355. So intraday, I think it tried at 360, and it's currently at 264. So we got like 100 points just to retrace to get back to where the bull market resumes, if you will. So basically, we've been in a correction since here. And this wasn't a breakout. I mean, the all-time high in the Hui was 625. So 350 wasn't even a breakout. So we're just trying to get back to where so back to, from 260 to 360 is still a retracement. And once the Hui gets above 300, cheap stocks are going to be going away very quickly. So yeah, so the miners will go a little lower. They're 260 right now. I think we're probably going to go down into the 230s. Say my target's 230 to 235, somewhere around there. Maybe we get lucky and we don't go that low. But I think we do. I think 230, 235 is kind of my target for the miners. But I don't think we're going sub 225. If we do go sub 225, I'll definitely be, an aggressive buyer, if you will. Once you get down, that's my buy zone, sub 225. I don't think we're going back there. Okay, so to follow up on the macro. Now, the reason why I think that the S&P is basically getting ready to hit its peak and roll over and in the next few weeks or the next few months is because the economy is slowing. A lot of people are talking about the retail apocalypse because all these retail companies are basically struggling right now. Well, that's not a strong, that's definitely not a sign of a strong economy. Then you have banking. There's been lots of articles about how the banking sector is basically not healthy. It was actually down 2% today, which was amazing because the stock market was up. But the banking industry is having trouble. Housing, housing is hanging in there because people don't like paying these high rents, and so they don't like to pay them. They'd rather pay a high mortgage than pay a high rent, and I kind of get that. And so anybody that can't afford a house is going to get one. And then you have a lot of the boomers who are helping their kids buy houses. So housing hasn't died yet, but it's definitely weak. It's definitely not strong, if you will, but new houses seem to be hanging in there. Um, but I think inventory is picking up. But I think overall, the housing industry, if you are a real estate agent, it probably feels like a downturn. I got to believe that. Autos is even worse than housing. I mean, if you're selling cars at a new dealership, I'm sure that the foot traffic has got to be pathetic right now, because who wants to buy a car at 8% interest? That's brutal, and so that's definitely huge headwinds for autos. And then cost of living. The cost of living is definitely hurting the average consumer. There's no and prices aren't going to come down. That's not what they do. Services. I mean, when have you had a service uh, fee go down? It doesn't happen, right? They either stay flat or they go up. And so the cost of living isn't going to come down. It's just not how it works. And so all that you can do on cost of living is try to catch up, try to get more income. But wages have not been going up, right? You're probably looking now, the average worker right now is looking at kind of pathetic pay raises. I mean, less than 5%. We're probably back to the 3-4% range and you can't, if you get a 3% or 4% raise, you're not catching up. Some people are getting 6% raise, but they're out of the norm. Yeah, the norm is probably 4%, 3%, which is because they're basically going to say inflation is at 3, so I'm going to give you a 3% raise. Well, if you get a 3% raise, you're not catching up. You're just spinning in place. So the cost of living is going to continue to bite, and then the unemployment rate is right at about 4%, but I think it's getting worse. The last employment jobs report, I think, was a joke, really. The BLS said that they added 260,000 jobs, and then the one where they call people at home was minus 400,000. There's a huge disconnect. And then the BLS uses a birth death model. And the one that when they call people the household survey, they don't use the birth death. It's more accurate, if you will, minus 400,000. And then full-time jobs has been kind of a train wreck since like last July. So the economy is slowing. I don't see it picking up speed. So I'm actually very negative. I think we're heading into a recession. And then once this S&P, once it rolls over, once we get sub 4,800, I think it's going to be, very. It's not going to. We're not going to crash, but what's going to happen is just everything's going to kind of slow to a crawl, which is going to be really ugly because when things slow to a crawl, it's going to be really hard, for instance, to replace your job. I mean, if you get, there's going to be a lot of layoffs, and if you get laid off, there's going to be nobody hiring. That's when it gets nasty. I don't know if you've lived through the last deep, serious recession from 2000 to 2002. But in that era, depending on what sector you were in, I mean, it was impossible to find a job in some fields. And I think that's what's going to happen again. I remember that there was 100,000 IT workers were laid off after the dot-com crash in 99, 2000, 100,000 in Colorado. I mean, if you worked in IT in Colorado in that period, there's no way you couldn't replace your job. There's too many people seeking jobs, and so that's kind of what's going to happen. I feel. Okay, how to analyze stocks. So the first thing I'm going to do all three. I'm going to do exploration, development, and I'm going to do producers. So exploration. So I was going to do Southern Silver. So for me, the one thing that I've learned is the easiest way to lose money is to invest in an early stage exploration play that doesn't have a significant discovery. Because what happens is they don't generate any income. And so they have to keep going back to the till and keep diluting shares to get more cash to drill. So if they don't hit anything on this, so they basically they have an annual drill program. And if they don't have a significant discovery, if they don't have some significant drill holes, their share price won't go up. In fact, it'll go down if they don't report any good ones. And so let's say you go into, and there's a lot of people that like to chase these stocks that, let's say they have a market cap under 20 million, and they don't have, a significant discovery hole that they're drilling out, and you invest in it, and the share price is like 50 cents, and let's say they have $3 million, and they go and drill, and basically they're going to use up all that cash, and they don't hit a significant hole, the share price will go down from like 50 cents to 40 cents because they didn't hit anything. Then they'll do a dilution and the share price will go from 40 cents to 30 cents. So in 1 year, your investment went down 40%. Now you're behind the 8 ball. And now what do you do? And I've seen that happen over and over again. So basically what I've found is you only want to invest in exploration companies that have a discovery, a known discovery, and they're drilling it out. It's getting bigger, right? And so you can chase like really good discovery holes, like Snowline, when they hit their first discovery hole. I mean, that was a perfect time to get in. You want to get in early and then hope that they hit a second follow-up hole. And Snowline did. You get that first discovery hole. I have another video on discovery holes on what to look for, but you want to make sure that these companies, they hit a discovery hole, not 50-gram meter. A 50-gram meter hole is not a discovery hole. Even 100-gram meter is not a discovery hole. It's got to be at least 200, 150, 200. It's kind of the minimum. So you want a significant discovery hole, then you chase it. Other than that, don't bet on these. I call them lottery picks. I've lost a lot of money trying it. I learned my lesson. And so I do it once in a while. Once in a while, you pick your spots and you just get a lot of FOMO. Like Solitario, I decided, they didn't have any drill holes. All they had was surface channels, but I like the surface channels. But the reason why I bet on Solitario is because they have these 2 large nickel JVs. So my downside was fairly limited. But I thought I was getting basically their drill story for free. So that was that one's pretty rare. Then other than that, what I like to do on exploration is optionality. And so the first one I'm going to show you is an optionality exploration company, Southern Silver. Another one that I did optionality was OMI, and I got in really early. So, I mean, these are companies that have a lot of gold and silver in the ground. Another one is Banyan. I mean, if you can buy gold in the ground for $10 and silver in the ground for 50 cents, and they're very large, your downside risk is somewhat limited. All you need now is higher gold or silver prices. So Southern Silver has 350 million ounces of silver equivalent, and their market cap is $70 million. So I'm showing you a few different ways to value it. So the first one is at $50 silver, the in situ value is $17 billion. 350 times $50, $17 billion. At 15%, it's worth $2.5 billion if it was in production. And so, they're not a producer, they're an explorer. But if they sold it to somebody, that company would probably be worth $2.5 billion if they were in production. Okay, now another way to value it is how much free cash flow if they were in production. So Southern Silver did PEA, it might have been PFS, of 14 million ounces a year production, annual production, but they're going to start at 14. So at $50 silver, let's say that their all-in cost is $25. So I'm being conservative, I think. But they're not going to get into production in, probably it's going to take them 3 years maybe. But at $50, okay, they would have $350 million in free cash flow. I think the multiple would be at least a 10 with those kind of margins. So that would be a $3.5 billion valuation if it was in production. So whoever buys this at $50, not today, so I'm hoping Southern Silver holds it until 50, but whoever buys this deposit is going to be worth, if we do the average of these two, about $3 billion if they're in production at 14 million ounces at $50 silver. And I actually think that's a pretty conservative number. So if you're going to be worth that much, what would you pay? I think somebody would easily pay, 300 million at $50 silver. Now, if we look at the valuation at $2 silver or $1, selling it at $2 an ounce or $1. So if they sold it at $2 an ounce, they would be worth 700 million. That's my upper range. If they sold it at $1, it would be 350 million. It's my lower range. And remember, at 10% would be about 300 million. So at $50 silver, if they sell this thing anywhere, I think 300 million would be kind of a good number, but if they sell it for 150 or 200, they'll be giving it away. And it's currently at 70. So maybe we get I don't think we're going to get a 5-bagger because these companies usually don't have patience. But this is one of the reasons why I don't like exploration stocks. It's kind of a one and done situation. Once they sell this project, it's kind of over for them. They have some other deposits, of course, but the value of the company is kind of dead once they sell this deposit. So it's kind of a one and done. You probably only going to get a 3-bagger here, maybe a little more, because I just don't think they're going to be patient. That's the reason why, these optionality plays, you usually don't get 5-baggers on the optionality, but you might get lucky and get a 3-bagger, but it's not super juicy. These exploration stocks are not super juicy unless you get in early. For instance, again, I use Snowline as an example. If you get it when they make that first initial discovery hole and you jump in right then, I think Snowline was under 50 million when they made that first discovery hole. So if you get in real early on those big discovery holes, then you can do really well. But it amazes me how people love exploration. Eric Sprott, he loves to chase these exploration plays, but the way that he does it, he presses his bet, and that's not easy to do. For instance, so he's got, if you own Southern, you get in early to these, you own a whole bunch of them, and then you wait, and then the company that does hit, you basically, you press your bet and add more to it. And then a lot of times he'll have, options or warrants to go with it. And but overall, I'm not really a big fan of exploration. If I had to do this all over again, I wouldn't buy any exploration stocks. I might do some optionality, but by and large, I'd focus on development and producers. Okay, development. So I'm going to look at Discovery Silver. So they have a market cap of $300 million. Now, there's a big risk with Discovery Silver. But for me, with development plays, they're always big risk. They're always high risk because things can go wrong. They usually do go wrong. I have this saying that you only make money on 20% or 25% of your development plays. Somewhere in there, 75% of them go south. And why do they go south? I mean, usually the reason why they go south is they either dilute you into the ground and you can't make it up. And they can, trust me, these development companies, they find ways to spend money. They'll dilute you into the ground or they'll sell the project before they get into production. It's usually one of those two. But sometimes the ramp up just doesn't work and these companies go bankrupt. I mean, that happened to Alexco. Well, Alexco was sold, but they were basically going bankrupt. Arcana, Pure Gold, those are three that come to mind that were that were recent, but there's been several that, ramp ups that kind of went south. So let's look at the check boxes. And then we'll go back to discovery. So, but I'll use discovery as an example going down the list. So the first thing you want is a strong project. So you want it to have at least a PEA, but ideally a DFS. If you have a DFS, that means you're close to production. So Discovery has a DFS. And then the DFS, you want it to show a really strong NAV versus the CapEx. So the CapEx, ideally you want the NAV to be about twice as big as the CapEx, but you want it to be at least 50% higher. Well, I say at least, but I would say at least 25%, but you want it 50 to 100% higher. If the NAV is larger than the CapEx, then it generally doesn't get built because the bank won't loan you any money. The IRR, you want the after-tax IRR to be at least 25%. I actually learned that from Rick Rule. He used to say 25% was kind of his cutoff. Now, I will go lower than 25% if the upside at higher silver price or higher gold price really moves the needle on the IRR. So let's say the IRR is like 15% at current prices, but it jumps to 25% fairly quickly. Then that'll change I will go lower. But if it's at 25% at current prices, then that gives you a really good, it's basically a very strong economic project. And Discovery's, we'll look at their numbers. They're actually really good. And then high upside potential. I want at least a 10 bagger. And the reason why I want at least a 10 bagger is because of the risk. I can get 5 baggers with producers. If I can get 5 baggers with producers, I want 10 baggers with developers. And the reason why you want to start out as a 10 bagger is because they're going to dilute you into the ground and you don't want to get too far behind the 8 ball. Strong management team, you're looking for experience. They have Tony McCooch as their CEO. He was the CEO of Kirkland Lake. I think they have a really good team. A path to production, you want a team, you want a company or a team that shows you exactly what they're going to do. And then they can basically explain, this is our plan. But you want a company that has a plan and it's laid out in a company presentation. I'm a real needler for making sure that these companies have a really good plan. And the plan is basically what the path, if they have a plan, then they can tell you their path to production. We're going to do this, this, and this to get to a construction decision, for instance. Now, sometimes I will have some leniency on companies if I think it has really high upside. In other words, but it has to, once in a while, you don't want to do it too often. Once or twice, you're not really comfortable with because you're getting in early, for instance. Sometimes you're getting in early and they really don't have a plan yet. A good example of this would be Aftermath. Aftermath Silver, they've been really, really slow to tell us exactly what their plan is to production. I don't even think they haven't even released a PEA yet. I don't even think we're going to get we might not get a PEA this year. But I bought Aftermath before I got the plan, the path to production. The reason why is because of the upside. It was just really cheap. So sometimes I will do it, but ideally I want a company that checks all the boxes. And the next box, and you definitely don't want to ignore this, is the insiders. If they don't have at least 25% and management with skin in the game, I would say 80% of the time they sell before they get it into production, especially when it's really low insiders. Because when they have strong insiders, because these are strong, these are really, really strong projects, and they're going to get a lot of phone calls. And when they get those calls, the only way they can basically say we're not interested is if they have high insiders. They cannot say that if they don't have it. Because let's say that they only have, 5% insiders and management only owns 1%. A good example of that is Avino, but they're a producer. If somebody calls Avino and says, yeah, I'm interested in basically acquiring your company, and we want to give you guys a 30% premium. Avino has to go to the board and basically say, a company wants to buy us, and they actually have to put it up for a vote. They can't just say no and turn them down. They have to literally, it's their fiduciary duty to let shareholders know that, hey, somebody wants to buy us for a 30% premium. You guys interested? That's why I say Avino is going to get taken out at like $35 silver. As soon as somebody's interested, there's no way that, because Avino doesn't have any insiders. I think management owns like 2% or less, and retail owns 80%. Institutions, so there's no strong insiders there. So as soon as somebody offers 30% premium, they're gone. And so we don't want that. We want these companies to get to first pour. We want these management teams. See, that's why I like Discovery Silver. Eric Sprott owns a big chunk of this, and their board knows that they're sitting on a gold mine if they get this thing permitted in Mexico. I mean, they have 1 billion ounces of silver. So, and their DFS only includes 500 million. So that half of their deposit is not even included in their upside. I mean, if we go and we look at their production, I have their free cash flow at $2.4 billion. This is free cash flow, 2.4 billion, and their market cap is 300 million. So Prince is a 23 bagger. That's with their current resource. That's with 500 million ounces of silver equivalent. They're going to produce 33 million ounces a year. That's why this is my favorite story, because it doesn't even include the entire deposit. They could actually ramp this thing up higher. After they get into production, silver prices are $50. The board goes, and when you're generating this much free cash flow, my goodness, what in the heck are you going to do with it? They're going to pay a dividend, they're going to buy back shares, and then they're going to expand production. It's a thing of beauty if they can get it, permitted. But can they get it permitted? We'll see. I think they will, because it's just too many jobs. You're talking about 2,000 full-time jobs at the mine, plus another indirect, probably 10,000 jobs. And the local community wants it. They're high-paying jobs. These are career jobs. These are jobs that are going to last 20, 30 years. This is a 30-year mine. They're going to mine, and look at this. They're going to mine. Okay. So year 4, it doesn't jump to 33 million until year 4. So we only get 23 million the first 3 years. But once they get that first year, people are going to bid this thing up, because they know that. So they're going to start at 26,000 tons per day, and then they're going to ramp it to 50, which is going to double production. So they're going to start at 23 and take it to 46. Well, no, actually the grade's going to go down. So it's going to go to 33. I think it's going to stay there. Well, maybe the average is 33 million. So they're going to start at 23. So the first 19 years are going to average 90 grams. So the grade is actually pretty good for 19 years. But they have 1.2 billion ounces of silver equivalent at 60 grams. And the price of gold and silver keep going higher. So the first 500 million is at 90 grams. So there's your 19 years at 500. So this thing is just monstrous. Will they get, basically, I'll take the risk. If they don't get permitted, fine. I'm not going to take a big allocation. Okay, the last one is producers. So with producers, you have more boxes and more check boxes and different check boxes. Every mining type has a different story, you have to have a different mindset to look at these. So Aya is at 1.4 billion. So the silver miners right now that I like is Silvercrest, but Silvercrest, it's really, great balance sheet. They don't have any debt. They have a lot of cash. It's basically about a 10-year mine life, but they probably can expand it to 12 or 14. But they don't have a pipeline, so I'm not really super excited about it. And then you have Hecla, which, I like Hecla. I could have easily done Hecla instead of Aya on here. But the reason why I like Aya is because it's just a nice growth story. So I want to talk about a little bit of Aya. Their 2 deposits they're just beautiful. They just keep getting bigger. We don't know how big it's going to be. So I like Aya as a growth story more than Hecla's. Hecla is also a growth story, but it's kind of an unknown. Whereas Aya, we know the production's coming. Okay, so the check boxes. First check box is strong upside potential. You want at least a 5-bagger, although a 3-bagger is okay if it's a growth story. So sometimes in the 3 or 4-baggers, sometimes if I think it's going to be a shark, I want to own this company. Like a good example would be Orla. I bought Orla Mining as a 3-bagger, but I'm like, this is a growth story. So sometimes I'll jump in if I think it's a real strong growth story. Another one I think was Artemis. I'm not sure, Artemis Gold. I'm like, this company is going to generate a lot of cash. They're going to find a way to grow. So if I think it's a growth story, I might go a little below 5, but 5's kind of usually my cutoff. The next one is a strong management team. I mean, it is really difficult to mine gold and silver. You see companies struggle all the time. I mean, Great Panther was in business for years and years, and they went bankrupt. It's a difficult thing. I mean, First Majestic, I mean, they did fantastic from 2005 till 2015. I mean, they did really, really well, and now they're struggling. I mean, who would have thought? I never thought I would see First Majestic struggle like they are right now. So you need a strong management team. It's really important. Good location. You got to be careful on location. Sometimes I will take risk. Argentina and Chile, I'll take some risk. Even Ecuador. I don't think I own anything in Ecuador right now, though. Silvercorp just bought a mine in Ecuador, so now I own Silvercorp. But on the whole, Ecuador is a bit of a risk. Even Mexico is starting to become a risk. I'm overweight Mexico. I'd like to lighten up. I'll be selling silver mines from $50 silver to $80 silver, lightening up because of the risk in Mexico. I want to be overweight Australia. I want to be overweight Canada and the US if they're currently producing. Places like Idaho, Nevada, Utah, I don't think those mines are going to be problematic going forward if they're already mining. It can be difficult to permit, absolutely. It can take you longer to permit in the US than it can in a lot of other places. West Africa, I definitely own a lot of there. I recognize the risk. So, the higher the risk, the less you want to allocate, but location is really important. Absolutely. Good balance sheet. I want companies that are cash focused, and it's amazing. Silvercrest, I really like the fact that they're cash focused. They got rid of their debt really fast. They added to the debt. We have Silvercrest, Westgold. Some companies are cash focused. I always thought First Majestic was going to be cash focused, and now they got a whole bunch of debt. I was like, that was a really bad mistake by them, I thought. Hecla and Coeur have never been cash focused. But I want, it's hard to find companies. I think is a cash focused company. I want companies that have at least 100 million in cash and no debt. And I'd like to see 250 million or higher in cash and no debt. Because once you have 250 million in cash on your balance sheet, it gives you so much flexibility. Number one, you can buy back shares annually. You can pay a dividend annually. I mean, so basically what you can do, you get 250 million in cash, and then you basically leave it there. And then everything above that can go out. So let's say you have 250 million in cash, and then you generate 500 million in free cash flow. You can take that 500 million, and half of it you can give a dividend, and half of it you can buy back shares. It's a beautiful situation. And then you can use that cash and you can leverage it to borrow money. Say, okay, I'm going to go build a mine. Instead of using my cash, I'm going to borrow 250 million. I'm going to pay it back. And you're going to easily get a good loan because you got 250 million in cash. So cash focus makes so much sense. I just don't understand why these companies haven't figured it out yet. Kirkland Lake, they use cash focus. They actually had at one time they had 750 million in cash on their balance sheet, and their multiple was just exploding. It got all the way up to above 25 because people love that. They love that cash focus. Investors love it, but nobody else wants to do it. I mean, if you look at Newmont or Barrick, they just hold tons of debt on their balance sheet. Even Agnico Eagle does. So we need a good cost structure. So you don't want a company that's high cost. Today I decided that I was going to sell a high cost company. I just don't think they're going to get their costs down. I'm not going to mention it, but tomorrow I'm going to sell it, and I'm going to swap it out for something else. I'm becoming more flexible on swapping stocks. If I don't like a stock, if the story's changed, if the cost of getting too high, and I don't think they're going to fix the cost, it printed as a three bagger, a little over a three bagger with high cost. And I'm like, why do I want a three bagger with high cost? I could use the money's going to be better spent somewhere else. So I'm swapping it out. So we don't want high cost. So what is high cost? Now, this was a gold miner. I think with silver miners, a different story, because silver miners, I think the price of silver, I think, is going to explode higher, and their cost structures are going to get fixed. Whereas, for instance, I think silver prices are going to double. Like right now they're at 29. I think they're going to double to 58.60. Whereas gold, I think there's only going to go up 25%. So you got like 3x better for silver versus gold. So if gold prices aren't going to really explode higher, then if they're currently high cost, they're going to remain high cost. They don't have any room really in this company. I mean, their cost. Oh, I can tell you their cost. Their ASIC 1750. So, and their ASIC, I mean, the best it's going to do is maybe go down to 1650 or 1600 at the best, and it probably won't. So it's basically going to remain a high cost company. Or 1750, and that's a high cost. I really want an ASIC for gold miners. I really don't want to go above 1600. As long as they're going to stay at 1600, ideally I'd like to do 1200 ASIC, 1200, 1400, 1500, somewhere in there, and 1000 is fantastic, right? So you want a good cost structure, because the cost structure is going to give you really good free cash flow, and it's going to give you a really good multiple. I want these companies, I want their multiples to expand. And the only way their multiples are going to expand is if their balance sheet improves. And if their balance sheet is going to improve when they get better margins, the better margins, their balance sheets are going to get fixed really fast. So yeah, good cost structure. Pipeline for growth. So remember, I mentioned Silvercrest. So Silvercrest, they really don't have a pipeline. I'm like, I'm not really happy about that. Another company that doesn't have much of a pipeline is First Majestic. I was really surprised when they told me that basically there's nothing coming out of Mexico as far as growth wise in the next, well, they didn't say anything. I mean, nothing in the next 3 to 5 years other than their existing mines. They said, well, we got lots of exploration potential at their existing mines. Well, from my standpoint, all they're going to do is expand the mine life. They're not really going to expand production on those mines. Great, you're going to expand the mine life. That's good, but I still want, where's your growth? I mean, they're mining about 20 million ounces silver equivalent in Mexico, and looks like they're kind of stuck at that level. But they're going to jump by 50% because in 2026, when they bring JC online, Jarrett Canyon, because that should come in about 175,000 ounces a year with an ASIC around 1,600. And so that's going to should take them up to about 30 million silver equivalent. So I'm going to wait for 2026. That's why I'm not swapping out First Majestic. But if First Majestic didn't have Jarrett Canyon, I would be tempted to swap it out here. But with Jarrett Canyon, I'm going to wait, because I think Jarrett Canyon is going to take them. My guess is it should take them to $40 to $50. They're currently about $6. So that's a pretty good return. You're looking at about a 5x, 6x, maybe 7x return on First Majestic in 2026 if we get $3,000 gold, $50 silver. And I think so that's okay. But pipelines are important. I want to see growth. If there's no growth there, I'm not happy. Silvercorp I've been really frustrated with Silvercorp over the years. They've never, they've been basically just been a cash cow over in China, and they've never expanded. And now they tried to do a deal in West Africa in a gold mine. I wasn't really happy with that. And then it fell through. Perseus got it. And now they're doing a copper gold mine in Ecuador. And I saw today that they're having legal issues on that one. Somebody's basically suing their environmental permit. But Silvercorp's disappointed me on their growth. but I want to see growth. I mean, that for me, I always say you make your money on the second line. Growth orientation. These two go hand in hand, right? I want a management team that's always looking for growth. You know, First Majestic, I mean, they've been selling projects. They haven't been buying projects. Why in the heck haven't they acquired Avino? Avino is going to can add 8 million ounces of silver. Why do you have to basically say, well, their costs are too high? I don't care if their costs are high today. Focus on the future. Don't focus on today. And it's like, I don't think that they would be, um, you know, I think their share price would go up if they paid a 30% premium for Vino today, because everybody would recognize, whoa, they're going to get 8 million ounces of additional production. And then they would do the math and they would say, wow, you know, because their costs are actually going to come down when they start adding that, when Avino starts adding that underground production that they acquired from Coeur. Yeah, they have higher costs, but at $30 silver, they're fine. And then every dollar above that, you know, they're going to be adding, you know, 3 million, 4 million every dollar. Actually, it's more than that. Yeah, every dollar free cash flow is going to be, you know, it depends how fast they expand the production there, but it's going to be, you know, $4 to $5 million every dollar it goes up. That adds up in a hurry. I mean, you go up $5, $20 million in free cash flow. So growth orientation. And then the last one is no significant red flags. This is kind of the intangibles, but every company is going to have a wart on it, right? There's going to be some type of a wart. Some of them don't have any warts. They're just pristine, but they're rare. And some of those warts are significant red flags. And it could be you know, it's kind of the intangibles, right? But you don't want to take a risk. If it has significant red flag, then it's usually always one thing that kind of sticks out. You go, you know, I don't like it. You know, it could be the CEO, it could be the chairman, it could be a number of things, location, possible risk, you know, no growth, who knows, but the intangibles, but you don't want any big red flags. That can be, so there's that. You could have, now, one thing about this video, I'm going to end it here, is you can screenshot some of this stuff, right? You can pause the video and screenshot it. But yeah, I hope you enjoyed it. That's it for today. So I'm going to call it quits in my video. All right, guys, I'll see you.